Hi everyone and welcome back to the channel and welcome to my first collab with another YouTuber. My co-host today will be Luke Baker from Investing for the Common Man. He has a great YouTube channel breaking down the basics of investing in stocks and options. He has a great series introducing option Greeks within 2 minutes or less, which is great for anyone looking for a crash course or just an options refresher. Please make sure to subscribe to his channel to show your support. Today we'll be discussing put credit spreads, also known as verticals. If you've been watching my live trading series, you know I like to use this strategy at least 3 times per week. I also give an update every month on my monthly income from this strategy. Let me first introduce the structure of this option strategy. A put credit spread is considered an intermediate option strategy, at least in my mind, and is achieved by selling an out of the money put option and buying an even further out of the money put option. This is considered a neutral to bullish option strategy. This means you should only apply a put credit spread on a stock or ETF you think will increase. However, you still have some room for error and still be profitable if the stock or ETF slightly decreases but remains above your strikes. You're predicting where a stock won't go. When you're selling a put option, you want the stock to increase, otherwise you'll be assigned shares. Stealing this analogy from my collab partner, a put credit spread is like selling insurance, and then buying insurance of your own even further out of the money to reduce the risk and then pocket the difference. Let's quickly go through an example using an ETF commonly used for put credit spreads, SPY. Assuming SPY is currently trading at $340 per share, we predict it won't go under $320 per share. Therefore, we sell a put for $5 at the $320 strike, and then for protection, we buy a put for $475 at the $319 strike, earning us the 25-cent premium. Why do we buy a put option though? Why not just sell a put and collect all the premium? There are 2 answers, capital and defined risk. In terms of capital, when selling this spread, we'll only need $100 in collateral. But how is this calculated? You'll take the width between your strikes. In this case, it's 320 minus 319 times 100, because options are 100 shares, which gives us our $100 collateral. If we have a small account, selling a loan put means we'll need $32,000 in capital in case we get assigned shares. However, if we do not have this, we'll need to buy a put to reduce the capital that is required. There's also lower risk associated with credit spreads, but why do I say that? Assume you sell a cash secured put at $320 for SPY, and then the unthinkable happens, SPY goes to zero. Since the purchaser is in the money, you're assigned shares. You're forced to buy 100 shares at $320 each. Since the ETF is worth zero, you've just lost $32,000. With a credit spread, your max loss is the collateral minus the premium. Your max loss is $75. This can be calculated by taking the difference between your strikes minus premium times 100. In this example, if you sell a 320-319 put credit spread and SPY goes to zero, your max loss is $75. Even though you're forced to buy the shares at $320, you then can turn around and sell them at $319.
Now that you've got an understanding of the basic structure of put credit spreads, let's take a look at the market factors that can affect this strategy. Single option contracts on their own are affected by time, volatility, probability, and the value of the underlying stock. As option traders, we can use the Greeks, delta, gamma, theta, and vega, to understand how the value of an option will be affected by changes in any of these variables. Put credit spreads, as well as many other multi-legged option strategies, combine 2 or more contracts to create a macro position that responds to the variables I mentioned before in more sophisticated ways. You can even calculate the net Greek values for a multi-legged option position by adding or subtracting the Greeks of the individual contracts that make up the strategy. As you can see here, the put credit spread strategy is similar to a simple short put, in that the strategy is delta positive, which means that the position profits as the stock price increases, theta positive, which means that the position profits as time passes, and vega negative, which means that the position profits when volatility decreases. But you may notice that all of these values are much smaller than that of a simple short put. That makes the spread a much less volatile position, because buying a protective put at a lower strike offsets the volatility of the short put. This is a popular strategy because it's neutral to bullish in nature, risk defined, and time is working for you instead of against you. This is also a popular strategy to use when volatility is very high, because you can collect more premium, and as expiration approaches, that volatility will likely drop rapidly. While this strategy has a lot going for it, it's also important to understand what could possibly go wrong and force you to take a loss. The main two risks that can cause your position to lose value are large spikes in volatility and dips in the share price of the underlying stock towards or through your strike prices. Changes in share price are relatively self-explanatory because they increase your risk of assignment, but increases in volatility can be a bit tricky because they're often triggered by unexpected world or market events. News events like an international military or diplomatic conflict, market crisis, or the announcement of an imminent takeover or merging of two companies can cause volatility to spike even if the underlying share price does not change significantly. The two things that you can control when setting up this strategy are selecting the expiration date of your contracts and the strike prices of your spread. The greater the time until expiration and the implied volatility of the underlying stock, the more premium that you'll be able to collect for each spread that you sell.
I use credit spreads frequently. I usually do short expirations, so maximum 5 days to expiration, and I'll even go as low as 0 days to expiration. I'm constantly looking to call the bottom or take advantage of high volatility around earnings. Please note, I like taking risk. My risk tolerance is high, so please don't use these examples as your own trades unless you fully understand the potential losses. Let's use a previous trade I did on AMD just a few weeks ago. I sold a spread 5 days before their Q2 earnings were released. Normal IV for AMD is around 50%, whereas earnings week had IV around 140%. But what does this mean? Why do I care about high IV? Higher volatility, higher extrinsic value means higher premiums. You'll have to pay more for an option with higher volatility. Therefore, me being the seller, I'll be earning more. I sold 30 contracts with a $5 wide strike and collected $12 per contract, or $360 total. This means I sold a put option for $55, and for protection, I bought the put option at $50. Notice my max loss per spread is $488. I was expecting AMD to increase, but even if they didn't, I had $50 of room before my spread was at risk. AMD trading at $70 meant the stock had to drop by 21% in 5 days for my spread to start losing money. If you've been trading options, you'll know that selling a put 20% under the current stock price doesn't yield high premiums. After commissions, you might not be making money at all for the risk you're taking. This is due to the probability of the stock going down by 20% in 5 days is incredibly low. Low risk means low reward. However, this is why I sell credit spreads near earnings while the IV is high. As a seller, high volatility increases the amount of premium I collect. Even if the trade starts to go against me after earnings, the IV drops significantly, known as IV crush, and I can usually still close the trade and be profitable.
The example that Bassem just described is a great way to pull in small amounts of premium in a short period of time with a very high probability of success. But this does make your capital requirement quite high in relation to your max gain. I trade options with a smaller account, so one of my favorite ways to set up this strategy is to collect a bit more premium and aim for a 20 to 80% risk to reward ratio. For instance, if I'm selling a $5 wide spread, I'll try to collect about $1 or more in premium. Remember, when we're talking about options, you always need to multiply by 100 because each option contract controls 100 shares. This leaves us with a strategy with a max gain of $100 and a max loss of $400. This generally works best as an intermediate term strategy, leaving about 20 to 30 days until expiration. If you're struggling to find strikes that are far enough out of the money for comfort, you may need to select a further expiration or select a different security with higher levels of implied volatility. You'll notice that the risk on this trade is still greater than the reward, but because we're going to set up our strikes out of the money, this strategy can still have a statistical chance of success of 75% or more. We can measure the statistical probability of your spread successfully expiring out of the money by looking at the delta of the put you are planning to sell and multiplying by 100. In addition to selecting a strategy with a high statistical probability of success, I use technical analysis and trends to further increase the likelihood of success. This strategy works well on stocks with a well-established upward trend, or if you set up your put spread below a well-established level of support that is likely to protect your spread. If you want to learn more about using technical analysis and support and resistance to help you plan your trades, I have a few instructional videos on this subject, and I'll leave a link to those in the description below. Normally, as this strategy approaches expiration, I'll try to close each spread a few days or even a week early for 5 cents, or rather $5 per spread. I find it's worth it to give up a small amount of profit to close the spreads early whenever possible. This practice decreases my risk of the stock moving against me at the last minute, and also allows me to redeploy that capital on other trades.
Let's talk about trade management. If the trade is slowly moving against you, you'll have to make a few choices on how to manage it. You can A, do nothing, or B, try to roll it out for a credit. Do nothing means you're willing to accept the max loss and walk away from the trade. Or to be assigned shares, hoping that the stock will rebound, allowing you a chance to recoup your losses. You've come to terms that your hypothesis on the stock or ETF is incorrect, you're willing to accept the loss and move on. Rolling out for a credit has two parts. First, you'll have to buy back your spread. Since you sold it, you have to buy to close. And second, selling another put credit spread at a lower strike. You'll only do this assuming you can still make money and you're still bullish on the stock. You still think the stock will increase. Let's just use a basic example to explain this. SPY is currently at $3.40 and you sell a $3.20, $3.19 spread collecting $5 in premium. However, SPY slowly starts to decrease, it starts trading near $3.21. You're afraid you'll either lose money if it breaches 20 or you'll be assigned shares. You buy to close for $8. You buy back the spread that you sold previously. You predict another bottom, you sell a $300, $2.99 spread for $5 at a further expiration. If the second trade is successful, we are able to walk away with $2 premium. Let's calculate our gains. We collected $5 initially and then closed it at $8 for a $3 loss on the trade. And then we sold our second trade, the successful one, for $5, leaving us with a $2 premium. This can sometimes work, but you might be better off taking a small loss rather than risking a string of unsuccessful trades. Please note, when you have to manage or roll a trade, you might be making less overall. Making all these trades will slowly incur commission fees, which will eat away at your earned income over time.
Alright, last but not least, let's talk about risk management. Whenever trading options, it's important to manage your risk so that you don't end up losing the majority of your account on a single trade that goes woefully against you. As much as the degenerates over at Wall Street Bets seem to encourage this big risk, big reward mentality, it's one of the fastest ways to blow up your trading account. Most portfolio managers set very specific risk management rules for their accounts. A pretty standard risk management practice is to limit your maximum loss on any one position to 1 to 3% of your entire portfolio value. This will look different for everyone, but for me that means I limit my maximum possible loss on short put spreads to less than $1,000. So if I'm selling a $2.50 wide put spread and collecting 50 cents premium, that means my max loss per contract would be $200, with my maximum gain being $50 per spread. With a risk tolerance of $1,000, I would limit myself to selling no more than 5 spreads, no matter how confident I feel about that trade. These are just the risk management rules that I use in my own portfolio and are only a suggestion. Another possible practice if you want to sell more spreads is to set a stop loss before the spread would reach its max loss and use that to calculate how many spreads your risk tolerance allows you to sell. After you open a position, if your sentiment ever changes towards the underlying stock and you're fearful that your spread might take maximum loss, I personally always sleep better at night when I choose to close the position early for a small gain or even a small loss than when I wait all the way until expiration and it's too late and I have to stomach that max loss.
That's all we have for you today. You're able to see how two different option traders with different account sizes and perspectives approach the same strategy in different ways. Everyone needs to develop their own trading style, their own trading plan that is in line with their goals, their time horizon, and their risk tolerance. If you enjoyed this video and enjoyed this collaboration, please like the video and subscribe to the channel. Then go over to Investing for the Common Man. I'll leave a description for everyone to follow. Like his video and subscribe to his channel as well. If you're new to options, please check out my Intro to Options series. And if you want to learn how to trade options or see someone doing it live, please check out my live trading series as well. Until next time, thanks guys.